IFRS 6 Exploration for and Evaluation of Mineral Resources was introduced to address the unique accounting challenges faced by entities operating in extractive industries such as mining, oil, and gas exploration. Before IFRS 6, accounting practices for exploration and evaluation expenditures varied significantly across jurisdictions and industries, reducing comparability and consistency in financial reporting. The standard provides temporary guidance allowing entities to continue using many existing accounting policies while establishing minimum requirements for recognition, impairment testing, and disclosure. IFRS 6 applies specifically to expenditures incurred after obtaining legal rights to explore for mineral resources and before technical feasibility and commercial viability are demonstrable. The standard does not apply to expenditures incurred before exploration rights are obtained or after commercial production begins. The initial measurement of exploration and evaluation assets includes expenditures directly associated with searching for and evaluating mineral resources. Examples of such costs include geological studies, geophysical investigations, exploratory drilling, trenching, sampling, and activities related to assessing technical feasibility and commercial viability. Costs associated with acquiring exploration rights, licenses, and permits may also be included. Entities may capitalize these expenditures as exploration and evaluation assets when they expect future economic benefits from successful discovery and extraction. Administrative and general overhead costs are capitalized only when directly attributable to exploration activities. IFRS 6 allows flexibility in accounting policies, provided they result in information that is relevant and reliable for users of financial statements within the extractive industry sector. Exploration and evaluation assets must be classified according to the nature of the assets acquired and the accounting policies adopted by the entity. Depending on their characteristics, these assets may be classified as tangible assets, such as drilling equipment and vehicles, or intangible assets, such as exploration licenses and drilling rights. Classification affects depreciation, amortization, and impairment treatment within financial statements. IFRS 6 also requires entities to apply classification consistently and disclose relevant accounting policies clearly. Once technical feasibility and commercial viability of extracting mineral resources become demonstrable, exploration and evaluation assets are no longer classified under IFRS 6. Instead, they are reclassified into development or production assets and accounted for under other applicable IFRS accounting standards such as IAS 16 or IAS 38. Impairment testing is a key feature of IFRS 6 because exploration activities involve significant uncertainty and risk. Exploration and evaluation assets must be tested for impairment when facts and circumstances suggest that carrying amounts may exceed recoverable amounts. Indicators of impairment include expiration of exploration rights, lack of planned exploration activities, unsuccessful exploration results, or insufficient evidence of commercially viable mineral resources. Unlike IAS 36, IFRS 6 allows exploration and evaluation assets to be tested at a higher level of aggregation, such as cash-generating units or groups of units associated with exploration areas. This flexibility recognizes the practical challenges involved in assessing recoverability during early-stage exploration activities where future economic benefits remain uncertain and highly dependent on geological findings. When impairment indicators exist, entities compare the carrying amount of exploration and evaluation assets with their recoverable amount, which is the higher of fair value less costs of disposal and value in use. If carrying amount exceeds recoverable amount, an impairment loss is recognized immediately in profit or loss. Impairment testing requires significant professional judgment because estimates depend heavily on geological information, market conditions, commodity prices, extraction costs, and regulatory factors. Once assets are impaired, future reversals may occur if circumstances improve and recoverable amounts increase. Proper impairment accounting ensures that financial statements do not overstate the value of exploration activities and provide stakeholders with realistic information regarding the economic viability and risks associated with extractive industry operations. Overall, IFRS 6 provides a specialized framework for accounting for exploration and evaluation expenditures within extractive industries. By allowing flexibility in accounting policies while imposing disclosure and impairment requirements, the standard balances practical industry considerations with the need for transparency and comparability in financial reporting. The classification and reclassification of exploration assets ensure that accounting treatment evolves appropriately as projects progress from exploration to development and production stages. Impairment testing requirements further protect against overstatement of uncertain exploration assets. For DipFRS candidates, understanding IFRS 6 is important because extractive industries involve substantial investment, high uncertainty, and specialized accounting challenges requiring careful application of IFRS principles and professional judgment within international financial reporting environments.